Hello, everyone. This is Dr. Bill Seeger from the College of Business and our corporate education program, welcoming you to, I believe it's the fifth in a series of COVID-19 webinars. We are very happy to have with us today Dr. Amy Cruz-Cutts, an economist, an expert on financial economics. And welcome, Amy, to you. Thank you for giving us your time. We really appreciate it.
Glad to be here, Bill.
Super. Well, before we get to the discussion, Amy, I've got a little administration to do. So just sit tight, and then I will get back to you in a moment. For our listeners, we'll go about 45 minutes. We have time for questions at the end. You can write in questions over the course of the discussion with Amy. Put them in the chat box, and Mike Woolman, my able-bodied assistant and colleague, will either break in at an appropriate time or hold them off to the end, and he'll take charge of getting the questions out to Amy. Often, you as listeners ask, how can we get a hold of the speaker? We'll provide that. Amy is all for questions. And if you have questions after this is over and want to write her, we're going to provide her email after we check with her and make sure we've got the one she wants us to give out. In addition, the webinars today will be recorded and posted on the corporate education website. So remember that you can always come back to that and listen to all the good advice we're going to hear from Amy today. So with that, let me turn my attention back to Amy. And Amy is a PhD economist. She got her PhD from the University of Virginia. A very, very prestigious PhD program in economics. But more important to this audience, she is the Trinity University graduate in San Antonio. So she has Texas roots, and we're happy with, obviously, always happy to have a native Texan or pretty close to a native Texan back with us. And her undergraduate degree was in mathematics. She's also a member of the National Association of Business Economics, as am I. And if any of you were listening to the first webinar, she's a good friend and colleague with Kevin Gleason, who was the opening guest of the webinar series. She's also the chief economist, I think president and chief economist of AC Cutts and Associates. So she has her own consulting firm. And I'm sure it consults either individuals or businesses in the area of financial economics. So welcome again, Amy, and I'll kind of get into this if you're ready.
Sure.
Okay. So as I talk to you, I thought our audience, after hearing from I'll say two macro economists. One, we had Bill Crowder talk about the macro economy and regional economy, particularly Southwest. And Kevin Gleason talked about the Federal Reserve and everything it was doing in its role to keep liquidity in the economy. And you're free to talk about that because you're a very interesting economist. But I wanted to have you here so we could kind of drill down from those aggregate macro kind of viewpoints. And you're going to give us the flavor of what's going on underneath those large tents, the big umbrellas. And the first area, for example, will be consumer finance. And people that have been hard hit by the COVID are saying things: can I still buy a home? Can I still get a car? What am I going to do? And then we talked about portfolio management. Okay, because people have been hard hit, I'm sure, by COVID, and they want to understand, what do I do going forward? Should I sell everything and start over? Should I stay put? And the purpose of this is not to give strict investment advice to anyone, but to have you talk in general about the challenges someone would face, and then from your expert opinion and your background, how to deal with it. So we know, just to get to the point, we know that the Fed is engaged in quantitative easing. They bought all the bonds, and I'm probably overstating it, but they bought the bonds the government sold for various stimulus programs. So they've expanded the money supply. And as we were talking earlier, you reminded me, liquidity is the key. So the Fed has been doing that, okay? But you've noticed something very interesting. There's been a lot of increase in deposits at banks in March and April. And, but credit card balances seem to be falling, or I should say, in addition, they are. And it appears that consumers aren't buying, but seem to be trying to save and pay down their debts. Can you make sense of that? I thought maybe, well, people, when they got the stimulus, were going to spend as opposed to save. So I'll turn it over to you. Thank you.
Sure. So let me back up a step because, there's so many questions that I'm sure you get and your other guests have had about, well, is this going to be like what we had in 08? 08 was a financial crisis predicated on a real estate bubble that was going back to an accounting change. And so we had huge speculations globally in the United States real estate market, particularly high-risk loans. And that led to terrible damage in the financial markets and subsequently a recession. And it was the worst recession in our lifetimes, right? Even back to the 1980s, which was pretty terrible. And particularly in Texas, the 1980s recessions were bad. But prior to that, we had nothing except the Great Depression to go on of a financial crisis nature, right? So that one sticks in our minds. This is not a financial crisis, and the Fed has done everything possible. When you say liquidity, they got more in stock. So, the next little weasel of trouble to stick its head up, the Fed's got another level to go on that. And this is important because in the Great Recession, or the financial crisis that preceded it, the Fed had to take out extraordinary measures and new and creative extraordinary measures. And in talking with Ben Bernanke before he took the job as Federal Reserve Chairman, he had spoken at length to me about his research on the Great Depression. That's really his specialty in academic research. And he noted so many of the mistakes that they made, that if they had the option to do something that was positive for the economy, they chose the negative. And he chose to make new mistakes. I'm sure scholars will come back over the next 50 years and say all the mistakes that were made then. But Jerome Powell and his colleagues on the FOMC have carried on that tradition with Ben Bernanke, which is, let's make mistakes not through not doing enough, but be criticized for doing too much, right? Because that's a much easier mistake to undo. The second thing that's important is this a recession? Well, technically, we're going to have 2 or more quarters of GDP decline, right? First quarter, definitely. Second quarter, third quarter, there's a lot of bets that one will be positive, but that'll be from a new low level, right?
Yeah.
But certain, and economically, if you think about the unemployment, we started that recession March 6th. So in that sense, but it's these consecutive declines. There's the technical definition, there's the unemployment. We're definitely in a recession, but it's not a recession in the normal sense. Normal sense is the ebb and flow of the business cycle. And this was a state mandated, and I use state to generally
the government
imposed of any level, stay-at-home orders. So that's very different than consumer demand and supply, business supply ebbing and flowing. The last possibility is it a natural disaster? It's the other one that comes up. Well, should I think about this like Hurricane Katrina, except on a national scale instead of several states? And the answer is, well, in that sense, it's like an act of God. Right, so there's no physical destruction like in a hurricane, but this closure of all these businesses, hopefully temporary, and all the other measures that have been put in place certainly act economically like a natural disaster. So let's hope it's temporary like a natural disaster. That is to say, when you get past the worst of it, we get the bounce back. Okay, all of that is a way to say when the fiscal stimulus came in, which by the way, I applaud Congress for coming together and being swift and being big. We can complain about how certain programs are not working perfectly, how they're not being allocated ideally, but it was not for lack of will to do something meaningful. And that's critically important, because in the Great Recession, we had fiscal stimulus, but it wasn't enough. And there was a view in Congress for those that settled to get that first bill passed is, that's okay, if we need more, we'll go back and get it. Well, by the time they went back to go back and get it, the structure of the House and Senate had changed, and they weren't able to get that across the finish line. And that was too bad, because it extended that pain much longer than it needed to be. So this time we got the two big plus bills passed through Congress. This is huge, right? CARES Act, the sheer numbers. If you'd asked me a year ago, would the particular Congress we have in place now be able to come together for an agreement on anything meaningful, it would have been slim to none, but that it was so big is really quite reassuring, I think. So what are consumers doing? They're taking those $1,200 an adult check and $600 children's checks, and they're putting that towards either rent or mortgage payments or to pay down credit cards. In Equifax's data, which, disclosure, I'm a consultant to Equifax, they have seen in just the past several weeks that credit card balances, which is a combination of people who use their card as a loan, that is to say charge and then pay off over time, and those people who charge like gas and groceries and pay it off every month. So we call those transactors. Combination of those two, it's down $80 billion. That's a pretty significant decline. So they're paying down debts. The folks that work in the collections industry that I've talked to have said that they're seeing a big uptick in people paying off collection items. So the consumer balance sheet has improved greatly. There's a nice entry in the 538 blog today that I saw. I don't know when he posted it, but that I saw today, that really talks about the impact of the unemployment benefits, particularly the federal unemployment benefits. And there's a lot of discussion about whether the $600 a week extra is detrimental to getting people back into work. You may have unemployment and you may be making more take-home pay. The sad thing is that for many of these workers, that it took a crisis to get their take-home pay to something meaningful, right? If $600 is doubling, that extra $600 a week is doubling your take-home pay, and you're working full-time, that's really a sad statement on the sheer number of workers who have moved into this situation. So the fault is not Congress giving them too much money on unemployment benefits. The fault really is in our economic system that doesn't allow them to make a decent wage. Right. And this is not casting aspersions on any particular employer or policy, just simply that our labor markets are filled with people who work at very, very low wages. Right. And that's created a lot of stress. But consumers are probably the best shape they could possibly be in. Going into this, they were not overly stressed. If you look at the Fed numbers on payment obligations, financial obligations, that's the series, financial obligations ratios, whether you're looking at the debt ratios or the total, including rent and cars, really low financial stress there. Again, these are aggregates, not individuals, but I contrast that with what we saw going into the Great Recession, where people were so overextended on mortgages that they never should have had in the first place, speculating in real estate markets. Very different situation. I think consumers are scarred by the Great Recession, and that that the increase in balances in bank deposits, what Bill was talking about is $2 trillion have entered into bank deposits in March and April that weren't there previously. And that's on a base of 13 trillion. So these are huge numbers. We saw a little bump in the Great Recession and then it quickly went down. These seem to have some staying power. Last week was up again, about another $200 billion. So really big numbers going into deposits. That's probably a combination of consumers who are no longer going out to spend money discretionary, right? We're not going to movie theaters. We're not going to music venues. We're not traveling. There's a lot of money, combination, like you mentioned, those unemployment benefits, but then for folks who've maintained their jobs, there's nothing to spend the money on. Retail sales fell by $150 billion in April.
Yeah. So,
we're not buying stuff. We're not going out. It's really a combination of two things. One, we got, a little bit of stimulus coming into the households, added with nowhere to spend it. So it's going into deposits and it's going into debt reduction. So really big things.
So I was listening very carefully to what you were saying, and I suppose could argue that this first round of stimulus is, as you suggested, people's balance sheets weren't in that good a shape. They used it to put them back, get their house in order, so to speak. But still, there's an incredible amount of deposits out there. Nobody's really buying. The housing market is going to get sluggish, or is already. Is it going to take what the Democrats want to do, another big bazooka of cash, in their proposed $3 trillion, in maybe a second phase? Since people have their house in order, now they might use the cash to spend. That's what I'm worried about, and wanted to get your sense. How are we going to get people out to spend?
Yeah, so it depends. It's not just the dollars, right? It matters where. So as an example, renters have been left out.
Right.
Largely, right? So homeowners, so I want to back up a little bit too of what we saw in the Great Recession versus now, and how the political arena has changed vis-a-vis the consumer. So in 2008, it was your own fault. You went out and bought a house that was too expensive, and now you want a bailout, and so the terms were very onerous. There were these repayment plans and modification plans. They were very onerous, and the choice there was a lot of discussion about so-called strategic default, but what happened was the timelines to foreclosure got extended very far. This had to do with a lot of judicial foreclosure states getting backlogged, and it could be 1,000 days between the due date of your last paid installment and the time of the foreclosure sale. So if I'm offering at the federal government this sort of rather punitive offer of a workout accommodation, or 1,000 days of free rent on a house that you're 40% upside down on, people took the 1,000 days of free rent. Why wouldn't you, right? You couldn't afford it to begin with. So, but I contrast that with today, because the CARES Act has specific language in it that really talks about sort of how this is a force majeure, that consumers are not to blame. And by automatically putting in the CARES Act, all you have to do is call your mortgage servicer and say, I've been impacted by COVID, and that's the statement. You don't have to demonstrate through reams of paper and all the ways you've been impacted, but simply that you have been, and I haven't talked to many who haven't somehow seen an impact, that you get the accommodation, you get the forbearance for up to 12 months, which is huge, and that comes with no penalty to your credit rating. Right? And this is huge. These were big deals, but there's no benefit to renters right now, and that's so I would hope that happens. And I love the idea of the payroll protection program, the idea that money could go to small businesses, but it hasn't turned out to be that way. And one of the big impediments to that is that banks are under something called the Know Your Customer rules. These are anti-money laundering rules. And so if you're a bank and you're faced with thousands and thousands of applications, and you're still under this Know Your Customer rule, the little guys, the truly little guys that, are all our friends that are calling to us and moaning about this, and rightly so, they're not going to get a loan if they don't already have an existing lending relationship, because the burden is too big. So there's some things that if Congress wants to send another $3 trillion in, or yes, they need more money. I think more money is the answer. I think that directed money and money shaped in the right form could be of enormous help. And in that I look to renter relief and true small business relief.
I wanted to ask you as well a little bit about more CARES. I think there's probably some material amount of reading there. Are there other aspects of that? You've talked about the forbearance, and I should have listened more carefully. Is that like a grant, or was that a house loan? If you could just So then you could go into some more. Maybe there are other aspects of CARES we should know about. Thank you.
Yeah. So the big thing is there were two types of debt that were specifically addressed in the CARES Act. One was student loans, and one was federally backed mortgages. And federally backed mortgages means mortgages that are insured by Freddie Mac or Fannie Mae, that are also, or those insured by the Federal Housing Administration, the Veterans Administration, the USDA, and there's a couple other smaller programs. So any of those programs If your loan is owned by them or insured by them, and it's easy enough to get that information, then, as I say, you can call your mortgage servicer and ask for a forbearance. And that can be anything from just an interest deferral. It can be interest and principal deferral. It can be taxes and insurance as well. So all of that is up for discussion with your servicer. And the initial period is 6 months. You can ask for another 6 months if you need it. And I can't speak for all the programs because I confess I have not gone down into their websites to find all of this, but Freddie Mac and Fannie Mae have come out with announcements about how this will end. And this is critical to this program, is that once you exit your accommodation, and so I'm using accommodation broadly to encompass any of the deals you might have worked out under the COVID-19, then it's going to be what in the industry we call a capitalize and reinstate, or cap and reinstate. So what they're going to do is extend the term for up to 12 more months and try to keep those payments level. And there's some issues still to work out about how deferral of principal and taxes and insurance might be handled, because that had to be paid out to the state and local governments and your insurance companies, and the servicers may need that as a catch-up payment earlier on. And these are some details to be worked out, but for the most part, that 12-month borrowing that you might do, forbearance will go to the end of your loan as another year added on. And that's tremendous. It's not going to be a lump sum. There is this vicious rumor going around, and I smacked somebody down again on Twitter today for that, about how when your 6 months is up, you're going to owe 6 months of mortgage payments. That is not how this works. There is no reason for me as a lender or an investor funding that to give you a timeout and then say, I'm going to put you in default.
Right.
I'll put you in default today. Skip the timeout part. So these will end with some sort of repayment program, regardless of what the lender is. If you do it as a lump sum, you're only going to cause the borrower to distress. And if enough of you do it, then the asset values will fall. Which, by the way, you mentioned about houses softening. Actually, existing home sales rose in the last month. In April, and the consensus expectation was, down hundreds of thousands, and it was up. So this was huge, and there's a reason for that, is that both supply and demand have contracted. Fannie Mae's been following this very closely in their surveys, and the world has not ended. It has taken a temporary timeout, and so while we think home sales will slow, the prices should hold up, provided the inventories have been so very tight. Depends on the market, but they've been so tight, and they've contracted more as people have held properties off the market, and buyers have also cut back, but more buyers think it's a great time to buy, and so prices are holding up, and I think that will continue as things get a little better and a little easier here on the restrictions. Let me get back to the CARES Act. There's some more pieces in there.
Right.
Student loans got a special provision. Automatically, federally backed student loans that are held by the Department of Education, and I contrast that with federal student loans that are held by universities. There's some special programs where the universities actually back the loans, and private student loans are excluded. Those federally backed ones automatically go into deferral until September 30th.
All right.
So that's, student loans are automatically going to deferral if you don't have your job and things like that. So they just automatically said, boom, you get that. There's a big difference though with the student loans versus the mortgage loans. If you're delinquent on a student loan, when it enters this accommodation, that delinquency is marked current and reported to credit bureaus as current.
Okay.
If you're delinquent on your mortgage, say 60 days behind, when you get the accommodation, unless you pay back those 2 months of payments during this time, then you'll continue to stay at 60 days. You won't be marked down 90 days and 120,
120,
but you'll stay at 60. So that's one difference. And unfortunately, the way credit bureau reporting happens, there's no special code that says Congress cares and you've gotten this accommodation. I wish there was. That would make it easy. So if you were to go in and check your credit report anytime now till whenever, and you look at your report, you might see that they marked you as affected by natural disaster, or that it's got a forbearance or a modification, or there might be deferred student loan in your mortgage box. That's because the special code for deferred usually only goes to student loans, so they kind of hardwired it into student loan. It's not that it's not that they made a mistake. It's like you have a limited number of codes to put in these boxes. The lenders and the CARES Act only said you're going to mark it to a 0 payment due, and you will not ding their credit. So current, they continue to market current and otherwise. So if you see these weird codes in your credit report, that's your servicer doing their very best to say this borrower was affected by COVID, they got an accommodation, and I'm trying to comply with the CARES Act.
Great.
Okay, but it's worth checking.
That's good to know.
If you've gotten an accommodation, particularly if you were delinquent in any way, or if not delinquent, making sure that it was recorded properly and you haven't now been marked delinquent, I would certainly suggest that you check that.
When you use the word deferral, I'm sure the answer is embedded in the word, if I understood the word better, in the sense that our lenders for mortgages or student loans simply adding the months you missed payments and the interest to the back end of the loan. So you still have to pay it, or they forgiving all of that, if you have an accommodation for the next 5 months.
So with respect to student loans, it's no additional interest. So it's a timeout on the student loan. Okay. With respect to mortgages, it's a really good question. I know that fees and other things are not allowed. And I'd have to go back and look at the language. With respect to, say, if you got a forbearance or a deferral on your auto loan, that's up to the lender because that's not specifically addressed. However, if they give you a COVID-related accommodation, the reporting is the same as on the mortgages, that they have to mark, they cannot continue to ding your credit if you're delinquent, and they can't take you from current into delinquency if they give you the forbearance. So, but the interest would continue to accrue, and that would be owed later.
And for what types of assets does this extend? That is the accommodation. If I just put in a new pool in my backyard, does that qualify? If I just bought a new John Deere tractor to cut grass in my field, and I had a loan, it's a material investment, personal investment. I mean, is it all of this or something very specific as you've enumerated?
Yeah, so just mortgages and student loans have specific requirements, and only for those federally backed programs. Everything else is at the discretion of the lender. Okay. But if the lender gives you the accommodation, they have to, so that the CARES Act amended the Fair Credit Reporting Act, which governs how stuff is reported to credit bureaus. So if you were to call up your tractor dealer and get that accommodation, they would, if they were reporting to credit bureaus, have to comply with the CARES Act.
Okay.
So, yeah.
Fantastic.
Yeah.
You've done a great job of talking about us broadly college students, and then mortgage holders, which we could maybe call young people and middle-class people that are often younger. But then there are people like myself. I'm still working, but because I like it, I could retire and sit on the back porch. And had I done that, I'd be sitting there worried about my portfolio and my pension or my 401k, and saying, everyone got a break here but me, because interest rates are low. I'm not really earning much on my portfolio. What do they get in the deal? The savers, the people that have retired that often suffer under these circumstances.
So I think it depends, obviously, on where your portfolio is located. So, if you're primarily the kind of person who has money in the bank, as opposed to in a mutual fund or with a financial advisor, then you're never gonna win that game in the context of true income, because interest rates paid by banks are never greater than the rate of inflation. And, right. Or, maybe for a short window of time, but generally that's not a way to get ahead. It is still important, though, to have liquid assets there, so you don't have to be eating into your stash of income producing assets, or what you hope will become income producing assets. And this, and again, in contrast with the Great Recession and the financial crisis, we saw that tremendous decline in the stock market during the financial crisis, and it felt like things were unfolding in very rapid time. Of course, I was at Freddie Mac at the time as their deputy chief economist. So to me, it felt like it was unfolding by the minute. But in reality, that was glacial compared to what we saw this time around. And it took a very long time for the stock market to recover. And the bond markets, of course, as you saw, the asset prices went up and the interest rates went down. What we saw this time around was the stock market came crashing down. It's back.
Yeah.
Like, it was like a dead cat bounce in an hour. I mean, it was phenomenal. And so where you're at and what your investment strategy is, I think that there are a lot of opportunities at the moment. It certainly has changed. There are segments that have done very, very well, some very surprisingly not doing well. Healthcare has not done well. And you would say, what do you mean? This is a healthcare crisis.
Yeah.
But of course, all of the things that were not acute related shut down. Your dentist offices shut down. Your eye care folks shut down, and your regular doctors shut down. So it really affected places you wouldn't have. Hospitality, of course, it affected them, but you wouldn't have expected doctors' offices in places like these diagnostic centers where you go in to get blood draws that are laying off 90% of their staff because nobody's going in to see their regular doctor.
Yeah,
so these kinds of things, where should you invest and what should you be looking out for? This is the kind of time where if you've got a great financial advisor who's really thought long and hard about which sliver of some segment is great to invest in, certainly have that discussion. But I think of it as a great time right now to be thinking less about the details and a little bit more in the big picture. And the beauty of what's happened in the last 20 some odd years is index funds that have really made it easy for people to get into investing, even if they don't have wealth advisors, and diversify that risk. But, it's hard for me to say because the segment this minute that's doing well could tomorrow not be doing well in this environment. So it's hard.
I see Mike Woolman. He might have appeared with questions. So
I do have a question. I didn't want to interrupt at all, but I thought it was timely based on the conversation from the audience. Mortgage rates generally roughly follow 10-year treasury rates. Why is it different now, and does it mean treasury yield is too low?
It's a great question. It's complicated a little bit by, there's two parts. So yes, they're generally tied to 10-year treasury. When you think of the mortgage rate, so I'm going to talk about one that might be posted by your bank or your mortgage lender. You get an email from your mortgage lender who says, mortgage rates are at all-time lows. Come and refinance with us. Okay, that rate is the 10-year treasury, the risk-free rate of return. So we've talked about that sometimes in our economics classes or finance classes. And you add to that what it costs Fannie Mae or Freddie Mac to fund a mortgage. So their cost of capital and the cost to insure that credit risk. Okay, that's called the required net yield. It is posted in a little out of the way corner on Fannie Mae's website. Freddie Mac used to, they no longer do. But if you look at that, Fannie Mae and Freddie Mac have had liquidity issues as well. And as the uncertainty with some of their policies have come into play, that has created a wedge between the 10-year treasury and the Fannie Mae rate. I'll just call it the Fannie Mae rate. Then what Fannie Mae requires versus what a bank requires to issue that, or the lender requires to issue that mortgage, includes the servicing fee, includes the profit to the bank and other costs. And their costs have gotten bigger as their liquidity has been constrained in the market. And liquidity is not, some of it is real and some of it is the risk premium that's being charged now, the extra additional risk. And so those two have blown it out about 90 basis points. So if mortgage rates kept the same spread to 10-year treasury, mortgage rates today would be 85 to 90 basis points lower than they are. But that liquidity stress in the market, that risk premium in the market has widened them out. That's, I'll take 3.5% for 30 years. That's an awesome rate, but wouldn't it be so much better if we could be at, 2.75 on a 30-year fixed, but for those problems.
I wanted to ask you another broad portfolio type question. arguably, if there's a debt overhang from what the government and the Federal Reserve have done jointly in their quick reaction to shutting down the economy, there's broadly, and maybe you can add to it, three things to do for the future. One, you could default on your debt. The U.S. won't do that. Two, you could raise taxes. Or three, you could use inflation to eliminate the debt. Let's say it's the last two, because I don't think we're going to default on our debt. Let's say it's the last two. What should people be doing, in the future after we begin, some recovery with their portfolio? So the question here is like a longer term view on the portfolio.
So with respect to the raising taxes, as an example, that $1,200 check that you might have gotten or that your children got, that's next year's tax return, sort of front loaded. So you'll get a little bit less back, depending on your income. If you're very low income, that's yours to keep. If you're in the sort of moderate high income, then but still qualified for that check, then that's going to be part of your taxes for next year.
Okay.
But that's still a benefit, right? You got the cash today when you needed it, and that's important. Some of these things are automatic stabilizers. Not enough of them, and I would like to see Congress address that a little bit better. If you expand out some of these things, food stamps and other things, that goes directly to serving households, and as soon as they get back on their feet, those go away. They get their jobs back and stuff, that goes away. So I'd like to see more of that. But there's sort of a medium ground in there, and that is that Treasury issues a bunch of stuff, the Fed buys it.
Right.
Okay, or the Fed went in and bought a lot of things in the marketplaces to create a buyer and liquidity in those. So they're earning income on that. That goes to paying down some of the debt, and then they sell those assets. That goes down to paying back some of the debt. So the Fed I look at as being sort of, again, another stabilizer
Okay.
in this process. And that's what they were doing that leading into this, right? They had started to liquidate a little bit of their mortgage portfolio and quite a bit of their Treasury portfolio. And they're thoughtful about it. They're not going to flood the market with these. The thing you don't want is for them to say, oh, well, we're going to reduce our portfolio and start selling the stuff, without careful thought. And what they had been doing is allowing runoff and not replacing and actively selling small amounts. And that was having no impact at all on the market in terms of moving the rates and things. So that was very good. I trust that'll happen again. With respect to inflation, I would so love to be talking to you 2 years from now as we go, man, this inflation stuff is, this 5 or 6% is really taking us for a ride. Because that would mean that we are so far on the flip side of where we are today that it would be a welcome problem. I don't think in a fiscal sense, we're going to inflate our way out of this. But to get to a place where we have enough demand that inflation becomes a new problem, I welcome that. That's, we are so far from that today. And I think that's not really the problem. The problem is, do you want to turn this in from a pandemic and this, for lack of a better term that I saw that I love, is a suppression, right? It's not a recession. It's not a depression. It's a suppression, right?
Suppression. Okay, great.
Yeah.
A new term.
My hope is that when we come out of that and are on the backside, that the economic engines will grow fast enough and perhaps that a lot of this debt will restructure itself automatically.
Okay.
But, we could see a little bit of inflation. I think of that as the least of our problems. And by the way, when we see inflation, it's not going to be because energy markets, like we saw, the inflation we had in the early 80s because of the oil embargo. And it's not going to be Weimar style, unless you think the government of the United States is going down, we're not going to see that kind of inflation. Could it be double digit? Who knows? No, that's so far ahead of us now. But I think that it will be, that the Fed will also do its job to work on that when we get to that point.
Great. I wanted to take, we've talked about liquidity. But then there's also that concept of Keynes, of the liquidity trap, and maybe one thing we all remember from macro. And so liquidity could be a problem under certain circumstances. what is it going to take for consumer confidence to rebound? Or do you think that some things that you'd cited about housing prices, and I think it was one other area of asset prices, surprised you that, they didn't weaken as much as you thought? And maybe that is an inkling of consumer confidence. Anyway, your thoughts.
Well, I think that will go a long way, certainly for financial confidence, right? If my home values are not falling and people aren't losing their homes to foreclosure, that goes a long way to making me feel a little more confident in things. Not everybody's in the stock market. We tend to look at the stock market as like a barometer somehow of consumer wealth. And there's certainly something to that, but it's not widely held by everybody. But if you think of, 65%-ish home ownership rate, I forget what the number is these days, but in that ballpark, that goes a long way to confidence. And that goes back to the CARES Act. The one thing they didn't want to do is force the asset liquidation. People get into trouble in their mortgage, they got to sell it, they're going to fire sale these things, and we're back in this trap that we had before with the foreclosures driving down asset values.
Asset price.
We don't want that, and that's a big difference. With respect to consumer sentiment, it's going to depend so much on how this reopening goes. And it doesn't help when you have folks flocking to beaches and acting like ninnies with the, I'm not going to wear a mask and all that.
Yeah.
But, here in Northern Virginia, where I'm based, we're still in phase 0. And they keep delaying our phase 1 reopening, which would be, say, hair salons with minimal capacity and things like that. We're still very much in a very slow mode here. And I think it will depend on how much those cases rise, and whether people feel they really can be more active and engaged. And if we can find a way to make this happen, I think the new normal, till the vaccine comes along, it'll be limping along at best until a vaccine comes and we're able to fully feel confident in our abilities to go and engage in social activities.
Have you seen any studies that have come out, any data that broadly say for every, additional month on average, the economy stays shut? That is, we don't open it up. This is the kind of GDP that we're gonna lose, because the recovery, as you say, is going to depend on how quickly the economy recovers. So if you're the governor of Michigan, I guess in a cost benefit sense, it's more important to close the economy than to worry about the trade-off I just talked about. Is there any data out there that's beginning to emerge to inform what's a legitimate debate?
Yeah, so to the extent that someone has done that, it would come out of a place like Moody's Analytics or Haver Analytics or Oxford Analytics, some of these folks that are in the business of macroeconomic forecasting as a service, certainly would have looked at that. But, I think we're in now for maybe the soft landing on the bottom, in that we're starting to open things that previously, we mentioned medical offices being closed.
Yeah.
And, that at least, again, here in my area, has opened up. So doctors are now seeing patients. They're still doing telemedicine, but if you need to come in, they're doing things. Dentists are now doing things. Veterinary clinics are opening up now again for more routine things. And a big part of their shutdowns was the PPE, the equipment that they felt would be needed by hospitals, and they didn't want to be hoarding that for these things. So I think we're kind of in for our soft landing on the bottom of the GDP. Think of that as a level of GDP. But the opening is not going to be a rebound back to normal. I think we're going to see a little bit of a bump off the bottom. I think of it as like a lazy V, or that Nike swoosh some people talk about recovery. That, we get something meaningful off the bottom, but it's a long slog back to whatever new normal is in that. And consumers, I think, once they start to hear of friends getting called back to jobs, and hopefully not a big rise in the number of cases in their local counties, consumer sentiment will start to come back.
I agree with you that the recession, February or March, as it's typically defined, what is it, BLS, Bureau of Labor Statistics, the economy will begin to rebound. I'd like your prediction on when we will be back to where we were as of, let's say, January 2020, back to the previous peak, if you will.
Yeah, so the Wall Street Journal surveys economists every month. It comes out the first, I'm going to give you a complicated way they schedule it. It comes out the first Tuesday after the first Friday. So basically the think of it as jobs report Friday. the next Tuesday
Say,
is they want the survey responses. And, you know, economists have been busy writing down their forecasts furiously, but one of the questions they asked is how long would it take for us to get back in, you know, various metrics. And my answer to that is it's going to take 5 years to get employment back. That's not to say we won't get some, but there are jobs that simply won't be coming back. And I can't say who, but you know the small businesses, some of them they're going to be gone. They're going to be done, and they may be already done.
Yeah.
And those particular jobs won't come back, and then certain industries will be affected more sharply. On a GDP sense, you know, that one's a lot harder to gauge. I know we're going to have likely a big bounce, whether it's third quarter or fourth quarter. It's going to be a big bounce in percentage terms because we've lost so much in levels.
Yeah.
But we're still going to be year over year down significantly come fourth quarter or first quarter next year.
Sure. Well, we're 45 minutes in. I want to give you this opportunity to get on your platform and please give us the most important takeaways from what you've said today. So, you know, our community can, you know, be successful in the future, for example, with your good advice. So what are the keys to your discussion today?
So the main thing I would say is for consumers, definitely take advantage of forbearances that are offered to you if you need them. Monitor your credit reports to make sure those are being reported accurately. Be patient with respect to your portfolio. Anything done in haste and fear is usually not your best plan. That's not to say we can't make mistakes otherwise, but you know, don't act out of fear. Act deliberately. And most importantly is to have a little bit of grace with your friends and family, and you know, understand that there's a lot of stress on everyone right now.
Great. Well, thank you so much. This has been fantastic. This is not only insightful, but useful. Sometimes they don't always come together, but they did today. So thank you. And now is time when my able colleague, Mike, is supposed to reappear, ask for questions, and maybe there are some other questions already. There he is. And what Mike likes to do is show off a little bit at this point. He often asks his own questions. So Mike, go ahead. Amy is all yours.
Yeah. Well, first and foremost, before I forget, I think at the top of the webinar, Dr. Kruskutz, you mentioned that if people had follow-up questions, is there a way they could maybe get in contact with you to send you an email with any questions that you may have, or anything you'd be able to provide? Yeah.
Like
Sure.
I have that email address of yours. Is that okay?
That's a great one. Yep, that's the perfect one.
And I was going to put it in the chat box. Can you remind me what it is?
Sure. It's Amy at accuts.com.
Okay. Thank you very much.
And, you know, I'm also on LinkedIn. That's another way to find me.
Perfect.
But,
oh, sorry.
However,
yeah, happy to take questions.
However, don't send her an in-mail because the type is too small.
Yeah. Oh, that stuff is too small, isn't it?
Right.
Yeah, exactly. So, any questions there, my friend?
So question has to do with, you know, although the forbearance may not affect the credit score that you have, if you're under an FHA loan currently, let's say, going into refinance possibly right now and switch over to a conventional loan, lender had basically in a specific situation had said that be very careful with forbearance because it could make it more difficult for you to qualify for a conventional loan if we see that you went into forbearance. Does that hold any weight to that, or second opinion needed?
Yeah, unfortunately it does, and it's you know, the CARES Act. I mentioned earlier how excited I was, or you know, thankful that Congress acted very quickly with the CARES Act. It kind of goes back to unintended consequences. So it's a great thing offering consumers the ability to delay payments on their mortgages for up to a year. But the flip side of that is that the credit policies, which are kind of hardwired, these things don't change very quickly. You know, a loan in forbearance really is not eligible for a refinance. Now you have two options. One is wait it out and see if they change their policies. And this is, we talked a little bit, Bill, about the HARP program. So this was the Home Affordable Refinance Program that was part of the Great Recession solution. Freddie Mac and Fannie Mae owned. loan could, finance loan could go through a refinance, even with blemishes and whatnot in your credit score, if they owned the loan. And there was basically, it didn't matter that it was underwater. It didn't matter what your credit score was, only that you were current when you applied. And for that reason, it was Freddie Mac and Fannie Mae already had the credit risk. Go ahead and refinance it, was the plan, was the thought under that. There is to date no such policy. I hope they will come up with a similar thing. And the reason for that is that, you know, if right now, for example, Fannie Mae or Freddie Mac or the FHA, you know, hold your loan, keeping you in the plan and the accommodation the way it is today, their risk doesn't change if they refinance back to that same lender, right? It might actually be lower because of the lower interest rate. Now, a flip side to that is we mentioned a little bit about what'll happen when you come out of this, that they're going to recapitalize the loan and extend the term. Well, at that point, they might offer something like a HARP refinance. And instead of just tacking it on as a longer term, they might do a full workout on the loan. They might do a refinance on the loan, make it eligible for that. Coming out of it would be another possibility. But yes, it is. If you're thinking about refinancing and taking advantage, if you've already entered an accommodation, you can get out of it by paying that month. And what happened is we've also seen a bunch of people apply for, get the accommodation, and make the payment anyway. So, you know, people have been doing that. So if you're current on the loan and not having any arrears, or you've got the money in the bank that you could make that payment up, you would be eligible for the refinance, provided it's not in forbearance when it's refinanced. If you're thinking about borrowing, maybe don't go into the accommodation program now. So, you know, these are some things that I love the CARES Act and a lot of things that it did. Some monkey wrenches, you know, some details that didn't get worked out ahead of time with the regulators and these policies.
Thank you. A question.
I was going to say, did you just see a question came in? If you did, great.
Yeah, a question just came in that says, do you think tightening mortgage borrowing standards is the right thing for the economy now?
Well, it depends on what side of the trade you're on, right? For the consumer, I would say absolutely not. We should be generous. If you're the lender, and you have to speak to investors, they're very careful to give you hundreds of thousands of dollars and not have that be repaid. So it is an automatic response on the part of lenders. And you know, we talked about spreads widening, that their uncertainty from their own liquidity, and part of this goes to also is that little known details of the mortgage market that you probably didn't know is that the company you send your mortgage payment to, they then have to advance payments to, say, maybe your mortgage is owned by Freddie Mac, but it's sponsored by the ABC Mortgage Company. And you pay your money to the ABC Mortgage Company, they're your servicer, they mail the check to Freddie Mac. Freddie Mac mails a check to investors, that is the holders of those mortgage-backed securities. Well, when you don't pay that loan, that servicer still has to pay Freddie Mac. They still have to pay FHA. Okay, Freddie Mac and Fannie Mae say, well, at the end of 4 months, you're good. We'll take it over from there, don't worry about it. You're only due 4 payments. Oh, you'll get that back later. Okay. On FHA, at least until recently, that was until that loan goes to foreclosure sale. That's when you'll get your money back, or when the account is made current. So these servicers were left advancing payments on behalf of borrowers with no liquidity of their own. And many of them were not banks. And there was some criticism that they were a bad business model and not adequately capitalized. Well, who has on the books 25% of their portfolio, the ability to advance funds for up to a year? That's an absurd amount of money. Nobody has that, right? So, so I think that those wrinkles are getting worked out. The contraction in the lending side really has to do more than anything with the liquidity constraints on these lenders and servicers. They're going to go the easy way out. I can process a refinance all day long on my prime book with very good equity positions. I can do that all day long. I'm not going to work with somebody who's got credit blemishes, is a little hard, is self-employed, all these things that make me work a lot harder. I mean, it's sort of a natural thing that comes out of this. And my hope is that these bottlenecks will get released. But think of it too, your underwriters, they're under the same stay-at-home restrictions we are. They're under capacity constraints that we are. Yeah. They've got homeschooling going on in the corner of their house, the same as we do. So, you know, the whole market has really had to suffer from this. And I think sometimes when we don't see it, we don't feel it. But they're under a tremendous amount of stress. How do you get an appraiser in your house
Right.
under
Yeah.
lockdown? Right. I mean, a lot of bottlenecks in these processes. So, so the tightening, some of it is automatic, some of it is a little bit fear reaction, but I don't think it's as tight as we thought it would be, except with the exception of all these new programs that came about and policies that came about so quickly and without solution.
Sorry. Do you see a second stimulus actually happening?
I do. In the end, Congress is a political beast. And if you're a congressperson looking for re-election, I think you have to fear the small businessman who's gone under because he didn't get relief a lot more than you have to worry about the inflation hawks or deficit hawks coming down on you for voting for that. You know, when people are suffering, they become a lot more flexible in their beliefs. And so, you know, I don't think either side can take it for granted at the moment.
Do you have any future events or online talks that you're going to be doing that could be tuned into?
Sure. I'm doing a weekly webinar with Equifax, and it's free to anybody who wants to. Sort of like this, it's just register and you get access. The beauty of it too is that the prior webinars are on their site. It's so if you want to Google search, it's Equifax Market Pulse.
I'm actually typing
and
Equifax.
yeah, Thursday's webinar will be with Jonathan Smoke at Cox Automotive. They're a Mannheim company. They do auto auctions on the wholesale side. He's got a lot of great information about auto lending in the auto market, used and new as well. So it's great to work with him again. We've done several on impacts of the CARES Act and accommodations on credit reporting with FICO impacts on credit scores and Vantage score. So a lot of good stuff coming out from there. They're free, they're weekly, and those are my main speaking events right now.
Great. I typed in Equifax Market Pulse so we could do a search on that for the audience. And do you have your own personal website? I believe, well, through AC Cuts and Associates, I guess you do have the company website.
Yeah, well, I own the site. I kind of got busy and I haven't had the chance to put up my own website. But yeah, I'm active on Twitter, less so on LinkedIn, but you can find me there and certainly find me for questions. And hope to be doing more. But then the end of the day comes before the end of my thoughts. So.
Right. Well, unless others have anything they want to chime in, that covered most of them that I could see here. But I will say, speaking personally here, this has been absolutely so valuable, this information that I've heard today, just on a personal consumer level. So I appreciate the time that you've given us to it, but I'll let Bill close out today and everything else. And eventually I will show what's coming up tomorrow. So.
Okay.
Well, thank you, Mike. Yes, Amy, I want to echo that. Fantastic. We really appreciate you coming on. You're very busy, much in demand. We can't thank you enough. If we can ever do anything for you, just let us know. And I wanted the audience to know that you had been scheduled to come face-to-face until COVID and have a seminar. And we decided, you and I, that we could try this out. So when maybe in the fall or the spring, when things have settled down, we'll have you back face-to-face and we'll be putting out those announcements, of course. The other thing I wanted to say is that all this is part of our corporate education program, and that's physically located in UTA Fort Worth, as you can see behind Mike, his backdrop. And Mike is the director of of that satellite campus, and I'm the director of corporate education. And remember, our goal is to get the best and the brightest to come and talk to our community about issues so that we all can be better decision makers. So that's our mission of corporate education. And once again, wanted to thank Dr. Amy Cruz Cutts. And now I'll have Mike tell us about upcoming webinars. And Mike, you should also mention that we're going to have one other one besides one listed with a colleague of yours. So please say that'll be a coming attraction, but please mention it. Over to you, Mike.
Yeah, thanks, Dr. Seeger. And again, Dr. Cruz-Cutts, can't thank you enough. Tomorrow we will be joined with Dr. Edmund Prater, who's the Executive Director of UTA Veterans Outreach Center and also a professor of business. He's going to be discussing supply chain and international trade disruptions. So kind of what we may have chatted about earlier, with goods and everything else in the stores and everything that have been changing right now with our supply chain situation. And one other thing that we just put, another webinar that Dr. Seeger mentioned that we just kind of added on is a healthcare focused webinar that we're going to be hosting with Dr. Tammy Eads. She oversees our RN to BSN program. She's also a very well-respected head of nursing in the state of Texas here. And she actually, I don't believe we have a date confirmed as of yet.
We don't have a date yet, but it's a coming attraction.
That's right. It's a coming attraction. So that should be in the next couple of weeks here. That we will be heavily marketing on our Corp Ed website, as you can see at the top there, for our upcoming events, where you could register for tomorrow's webinar if you'd like to come online and see Dr. Prater. And then Dr. Eads, we will be listing hers as soon as there's a date and time confirmed.
So I guess with that, Mike, did you have anything else?
No, I would just say that, we cannot wait, just like most places are around the country right now, to get to a safe enough place where face-to-face interaction can come. And I can't say how excited I am to welcome you to our satellite campus, Dr. Cruz-Cutts, in the future, and to be able to see our downtown Fort Worth campus so that you could educate folks in person, with our corporate education initiative. We're excited about this launching right now.
I'd love to come back to Fort Worth. I loved it there.
Great, thank you.
Great. So thanks, everyone. Thanks to Dr. Cruz-Cutts once again. And we'll see you tomorrow. That is Michael and I. Everyone take care and, be safe. Thanks.
Take care.
Bye-bye.
Bye-bye.